Welcome back. Let's get straight to reaction to that Bill Ackman interview with the panel. Joining me today, we've got Jin LeCamp from UBS, Dani Hughes from Divine Capital, our very own Dom Chu, and Kayla Tausche. We're also joined by fast money trader Brian Kelly. So it's great to see all of you. And look, Bill Ackman is now vehemently wading into this discussion, saying that Fannie and Freddie have to stay in this economy, have to support the U.S. housing market. Kayla, I mean, we saw a reaction to Freddie as that presentation was taking place towards the end of the trading session, but it suddenly looks like the reform bill that was supposed to get rid of these two isn't going anywhere, and now the coalition is to support these names.
Right. Well, of course, it being a midterm election year, there's the suspicion that nothing will happen in any direction until 2017 once we finally get the dust settling in Congress. But if you look at what the banks are doing, they are actually going ahead and making a bet that Fannie and Freddie will not be around, or at least they're hedging against that possibility. They're going ahead and they're still underwriting mortgages. I don't agree with what Bill Ackman said when he said that the 30-year mortgage is such a fixture in the American economy. It would go away if Fannie and Freddie got wound down. I don't agree with that because the banks are still underwriting them. They're just keeping these mortgages on their books, and they're only underwriting higher quality mortgages in order to do that.
That is an important issue. And Jim, this is the case that people make when they want to keep Fannie and Freddie intact. They say, look, if these go away, it means, and as Kayla said, some people disagree with this, it means the end of 20 and 30-year fixed-rate mortgages. It means the end of low-income home ownership in this country. It means that home prices for everybody will fall because suddenly the composition of demand is shifting. I'm curious how you guys have viewed this whole thing. You know, from a top level, from a portfolio point of view, what happens now if it looks like the pendulum is swinging the other way towards keeping them intact?
Well, look, I mean, who wouldn't want to own a business like that that's funded by endless amounts of taxpayer dollars, which is what got us into a whole lot of trouble in the first place. The reason there's not any other big players around is they were driven out of business because Fannie and Freddie could lose as much money as they want and still get those taxpayer dollar bailouts. So they need to wind these down. And if they aren't going to wind them down, they're going to have to tell us exactly what the structure is going to be. Because if it's going to be another taxpayer-funded boondoggle, we don't need them, and we should just get rid of them and let private companies fill up that space, even if it's slowly.
And there was momentum towards doing that, Dani, but now it seems like it's not there. And in fact, that the issue becomes one of Fannie and Freddie being too big to replace, as Nick Timrose over at the Journal, who covers this quite well, just put it. Because in other words, what Bill Ackman is saying is you can never get private companies from zero to the size and capital levels of Fannie and Freddie in enough time to avoid collateral damage to the housing market.
That's right, and we got ourselves into this mess to begin with. Even their own regulator just last week, a report came out, said that unless they had an additional $190 billion, they could fail again in another downturn. You know, but everybody hangs on these hedge fund big guys. Their last word, and markets move on these things. And they made a great bet, so did a lot of other investors. But I can't see over time how a very boring business is going to give you those outsized returns that the hedge fund guys are looking for.
Well, it's a royalty on on every home in America, I think was one way that Ackman put it. And Dom, it's interesting. He has a way with words. I'm surprised that he's potentially wading back into another Washington battleground, but perhaps that shouldn't be.
Well, again, Bill Ackman is charming. He's charismatic. He's obviously very smart. He's had a pretty decent track record so far this year. He's taken his hits in the past. But what I find interesting about this is you take it to a more macro level. Earlier at the Arizona conference, you had Jeffrey Gundlach talking very much about the housing market, by the way, about how he's shorting single-family housing. He thinks it's overvalued, overrated. Right. Whether or not those 30-year fixed-rate mortgages are going to be as important going forward, if Jeffrey Gundlach is right about the long-term demographics, about younger people not wanting to buy homes, whether the rental economy is here to stay for at least the next foreseeable, 5 or 10 years from now, that's going to be really key. So whether or not Fannie and Freddie are going to be successful, maybe he can turn it around, maybe he can't, but there are certainly he and a lot of other shareholders, hedge funds in particular, that really want to get in on this action.
And Don, people are having a hard time getting mortgages right now anyway. The lending standards have gone way up. You have to put a lot more money down. You can get, if you have 770 on your credit score, you can get a loan and you put money down. So it's not like this is a really well-operating machine right now. The housing market has some problems.
Right, but even if you do have that credit score and even if you do qualify for the mortgage, you could still lose out to an all-cash buyer, which is what's happening left and right. I just think the economy is changing in such a way that the rental economy is huge. Lower credit score consumers can't get these mortgages, and banks are really only servicing the high-quality mortgages, and that's going to be a trend that sticks around.
BK, go ahead, sir. Sorry.
So, I mean, listen to the signal that Bill Ackman is saying. He's invested in Fannie and Freddie because because the private market can't earn a return on it, so it has to be government supported. That's not a market that's fantastic for investing in terms of housing. What does that signal give to everybody else? It says, you know what? If you loan money for 30 years, it's a bad business. Who wants to be in that? If you take that marginal buyer away.
I'm not sure that that's what he's saying. I think what he's saying is just that the business of actually of being Fannie Freddie, of using their brand name to underwrite these mortgages, to package them, to keep the market functioning effectively as is, that's a different thing than talking about the rate exposure, for example.
Well, what he said was that the rate of return could not be earned that was sufficient to bring a private market buyer in. Therefore, it has to be subsidized by a government buyer. My point being is if you can't loan money at 30 years and make a reasonable rate of return, that's not a good business to be in, and I don't want to be in the housing. So what does the individual investor do? You go with Bill Ackman and you buy Fannie Mae, and you go with Jeff Gundlach and you short XHB.
Ooh,
there's a trade.
1-2 punch.
How's that
I wish we could keep this going. Brian, thank you so much for joining us and for sticking around. And also, please, everybody, be sure to stick around and catch Brian Kelly coming up with the rest of the Fast Money crew at 5 p.m. I'm sure that they will have much more on this.